All protocols observed. Good morning to you all, and thank you again for taking time to join us this morning. Please allow me to share with you a few thoughts as a preamble to this morning's session, entitled, Why Private Equity Hasn't Happened. In this room, there are senior bank executives, credit unions, pension plans, insurance companies, securities dealers, stockbrokers, traders, other non-bank financial institutions, and of course, institutional and individual investors who would have participated for decades in a reasonably active TT debt capital market. These issuers have been, for the most part, government, quasi-government, and large corporate entities concentrated across few sectors. As our local debt market grew, traditional financial institutions were only too happy to grow their balance sheets, with these assets coming in the form of bonds, short-term notes, syndicated loans, and other debt securities, all of which have been long considered less risky when compared to the asset class of equities, generally deemed high risk, or as they say in contemporary investment lingo, the risk-on trade. With the passage of time, the debt levels on local corporate balance sheets continue to grow for seasoned issuers, such as publicly traded companies, who, at the beginning of this debt cycle, had the capacity to access borrowings due largely to the presence of shareholder equity. This equity capital enabled such capital market borrowers, to satisfy our beloved lenders' debt-to-equity ratio requirement, a key metric in the pre-financing, due diligence, and post-financing stages appearing in the covenants of term sheets for the latter. In short, the presence of equity on the balance sheets of these elder borrowers gave life to debt. It is important to note the following. Number one, prior to the establishment of the local stock exchange, the majority, if not all, of these listed companies were private entities with founders or private equity, very pivotal to their proceeding to the stock market. Two, as at October 2015, there were 6,647 private equity finance firms in the United States. In our Aspire Fund's perfect world, using our population of 1.3 and the US population of 322 million, on a scale basis, that should ideally translate to 27 private equity vehicles in Trinidad and Tobago. But we'll talk about that later. Number three, from February 1st, of this year to the time of writing, 100 new companies began trading on the New York Stock Exchange and on the NASDAQ. In other words, 100 private companies who started their journey enabled by private equity are now publicly traded Wall Street companies. It is no secret that the US stock market, finding its residence in the world's largest economy, is ultimately where America's wealth is stored, created, and recorded. And it is equally clear that ownership is understood to be the true avenue to wealth creation. They get it. Do we? Despite the obvious ability to mobilize debt from the financial services sector, once a company has evidenced the presence of tangible equity on its balance sheet, there are few private equity vehicles in existence locally to mobilize this form of capital, and the skewness to debt financing has oftentimes led to inappropriate balance sheet recommendations and prescriptions. So it begs the question, why haven't we followed suit in our own environment? It is at this juncture I'd like to invite my co-panelists to join me on the stage. Sana Ragbir is the First Citizens Investment Services General Manager, a strong advocate for private equity, and we are delighted to have you here. Thank you, Sana. Dwayne Hinkson, another champion of private equity. We have Mr. Gittins, Hayden Gittins, who is the CEO of the Securities and Exchange Commission, who has brought a tremendous amount of wealth, of knowledge from the corporate banking sector. And of course, we have Mr. Joseph Remy, who is the president of the Trinidad and Tobago Credit Union League, also well known in the trade union movement. So at this juncture, I will join them so we can begin our discussion. The first question, I'm going to go ladies first. Prior to the establishment of the local stock exchange, the majority, if not all of these listed companies with private entities, with founders, private equity, very pivotal to proceeding to the stock exchange. Approximately 265 million US dollars in private equity was raised over the last 4 years in Jamaica via the Jamaica Venture Capital Program, or the JVCP. As at today, Jamaica's junior stock exchange has 43 traded companies. Their senior stock exchange has consistently been one of the top performing exchanges globally for successive years. Why do you think they are doing well? And why is there a relative absence of private equity vehicles locally?
If we look at Jamaica, first of all, Chris, if you look at the past few years in Jamaica, there's been a growing economy and they're experiencing currently a boom. And as a result of that, Jamaica, traditionally, if you look back years in Jamaica, they have grown accustomed to double-digit returns on their debt, their government debt. There was a time their government debt gave them double-digit returns. But with the growing economy that they've been experiencing over the last few years, you've seen where those returns have gone down tremendously. And Jamaican investors, because they've grown accustomed to those returns, they've gone in a search for yield and a hunt for yield. So they would have turned a couple of years ago to their local stock market. And there you would have seen one of the main drivers for their strong performance over the past 5 years is that demand. Because again, they've gone after the returns in their local stock market, and now their dividend yields are even lower than the dividend yields in Trinidad. And then, with the lowering of their dividend yields in their stock markets, they're now looking to private equity. So you see where in the past 3 to 4 years, private equity has really surged in Jamaica, again, on the hunt for yield. So it's really a function of their appetite for risk, their hunt for yields, and knowing that they are willing to take that risk, and you have the vehicles, the private equity vehicles that exist in Jamaica. In Trinidad, if you look, we have almost an opposite story. We've had an economy that has not, over the past few years, has actually been on a decline. Wealth has been deteriorating in the hands of the investors. Liquidity has gone down. And while, if you look back about 6, 7 years ago, we would have gone into the stock markets with various IPOs, again, in search of yields, we have in the recent past 2 years seen where government yields have now gone back up. So what we're seeing is a shift in the market back into the traditional products, because again, moving away from the equity back into the traditional products because of that shift in interest rates.
You have to look at the differences between the two countries and then where things have gone to understand why things are the way they are in Jamaica now versus here. Jamaica burned down a couple of years ago. The economy crashed, and they were able, in a sense, to kind of reset. Necessity is the mother of invention, and coming out of that, beyond the technical analysis that Sana would have just stated, there was also a shift culturally in how the market needed to be approached. And I think rather than get into technicals, the biggest problem, or one of the biggest challenges I see in Trinidad, is culturally how we approach equity. And it's because of a number of things that Chris would have mentioned, our history, and also Howard would have mentioned, our history with banks being the dominant source of capital in the country, our economic makeup being oil and gas based, which we have ridden for the past century, has afforded us the level of conservatism that now is challenging us to try and move our capital markets forward. So I think that we have to look beyond the structural makeup of our economy and the structural makeup of the capital markets and go deeper into the cultural approach that we have to the capital market, because only when that takes place, and it has to take place across the different roles that we have people playing. There's the regulator, there are the potential entrepreneurs, the potential investors, there are the intermediaries, and everybody has to start to turn in the same direction if we're actually going to move things forward. It's still very easy to think that we have a large private sector, but we have a number of private sector entities that really only exist because they have government contracts. And if you look at a lot of market-driven, pure private sector entities, the scale of our private sector goes down. And those are the ones, as we're talking about, investing in worthy businesses, as I looked at, the wording on Aspire funds, those are the ones that are going to have a better chance of being successful and sustainable in accessing the market. So there's the role of the entrepreneur or the small business. There's the role of the different types of private equity investors, because the angel investors do fundamentally look for different things than the private equity investors. So the seed capital looks at different things for the secondary and tertiary capital rounds. The regulator's role to put a framework in place and then stay the hell out of the way, out of the market. No offense, Hayden.
No offense.
Of course, the investors themselves and even the banks in terms of how they approach, capital and their views on capital. I'm glad to see First Citizens here and a number of the other banks who are starting to look more actively at private equity as a viable source. But there are just so many things that we could have a separate conference on, looking at the motivations for this to take place, that we could go on and on. And of course, one of the key things that we didn't mention, and I'm sure you'll touch on it later, is the exit strategy. One of the reasons that private equity still hasn't really taken off here is because the exit strategy for investors into private equity is still very, very limited, very thin. And no matter how much you think that you want to help in the development of this aspect of the market, when you invest in your capital and you're looking for that return, it can't be an illiquid return. You have to be able to get out. And that's why I'm glad Hayden is here and some of the others, because if we can find a way to enable that exit strategy via increased liquidity in whether it be the junior or the senior markets, and we start to get more people participating in the market, I think that in itself will significantly aid the growth of private equity.
I like to look at things in a historical perspective and have certain and develop theories based on that. I was in Jamaica working between 2001 and 2003, right after the banking market collapsed, as indicated by Dwayne. And the scenario there was grave. There were basically two large banks operating. Super high interest rates, commercial rates between 20 and 25%, savings rates in the early high teens. And essentially, the banks were only willing to listen to AAA grade credits. And I sort of traced that to part of what fed into the development of the privates. So credits that may not have been considered to be AAA had no banking option. And that created a fertile market, in my view, for development of the private equity market in Jamaica. Angel investors, private equity investors, and so on. In my view, what kind of drove the subsequent growth, explosive growth of the stock market is, of course, IMF entered. All the madness that was taking place with respect to the repo market, because as you know, at that time, the market was GOJ issues and repo trading in a kind of crazy way. That ended. Government had to come out of the market substantially. Rates had to go down. So you had a situation for a time where there was tremendous surplus liquidity looking for return. And that created, again, a fertile ground for as the venture capital, as the private equity issues matured, for transition into the traditional junior and main stock exchanges, in my view. That's my theory. Now let's compare it with Trinidad. How did Trinidad's investment culture develop? Trinidad has the largest, by some distance, mutual fund market in the Caribbean for good reason. We had and we still have a situation where people can invest in mutual funds at relatively high yields. I mean, they're much lower now, but at the time, very high. Fixed NAV guarantees or quasi-guaranteed funds. And that's how the investment culture developed in Trinidad. And in my view, that is one main reason for the sort of risk aversion, risk appetite, in my view. Substantial. We're talking about, at this point, close to $55 billion in funds under management. Over half of that still protected, fixed NAV or guaranteed. So that, in my view, didn't create or inhibited the development of a let's call it a less risk-averse culture, and kind of has led us to where we are today. You know, so I just kind of put forward those two theories to explain what happened in Jamaica and why, and what happened in Trinidad and what continues to happen, why our culture is so risk averse.
So with respect to the Jamaican experience, and I wouldn't go into the technicalities of the stock market and all this, but from a credit union perspective, being involved in the Caribbean credit union movement and the Jamaican experience, Jamaica has a unique structure in that the Jamaican, JACUL as they call it, Jamaica Cooperative Credit Union League, is in total control of all the aspects of the cooperative credit union movement. They have under their wings the financing aspect of the cooperative credit union movement. They also have the stabilization fund aspect, they still call it that. And then they have a solution center where they provide technical and education solutions to the entire cooperative credit union movement, all under the umbrella of JACUL. And I think that has allowed them to be structured in a particular kind of way and very stable. What they would have done through their investment arm was to look at the market and see how the things were changing. And I could recall in having discussions with the president then and the president now, they had serious challenges when Jamaica was under the IMF control. They had a very liquid situation and they could not have done much in those circumstances. But they eventually found themselves into the private equity market, which allowed the Jamaican Credit Union League to realize some returns and at least maximize their investment and give the members a significant return. It reached to the point where the stabilization fund was in such a buoyant position that they were able to return funds to the members of the fund based on the fact that it was doing well based on their involvement in that equity market. As reversed in Trinidad and Tobago, we don't have a similar structure to Jamaica, the JACUL League. What we still are striving for in Trinidad is that kind of structure where there will be one strong umbrella body that has the financing and the stabilization aspect and the aspect where we could provide services to our members. And in that way, we would be in a better position to explore the market options with respect to private equity as against what we are rigidly controlled under based on our regulator. And it's not this regulator, it's the Commission for Cooperative Development. In that credit unions have to get permission from the regulator with respect to the type of investments that they engage in. And that limits credit unions in terms of how the kind of risk that they take and the appetite they have for certain risks. And as such, you find they're very conservative by nature in terms of how they invest. And that to us is something that we are seeing a deviation from right now because of the current market conditions, because of the high unemployment level, and the fact that we had severe retrenchment that has impacted on credit unions' membership base and the ability of members to access loans. You find that for credit unions to balance and to reach back to a point where they have enough returns that they could put it back to their membership, they have to go into investments, a little higher risk investments, and you're finding now that some of them are moving. So we have over 15 to 16 credit unions from the league who are now actively involved with KCL in terms of looking at their investment portfolios and how we can manage it. So we have learned from the Jamaican experience, but I think in Trinidad and Tobago, based on our culture, we have to make some fundamental shifts at this particular point in time.
Thank you very much for these responses. The second question is more along the lines of our cultural approach to financial assets and investments. And it goes, the same macroeconomic industry and financial information an investment analyst would use to approve lending to a borrower or buying that borrower's bonds is the same information that very analyst would use to decline taking an equity position in the same entity. Are we culturally averse to ownership? And if so, why is that? Sana?
So Chris, you're saying that an investment analyst would use the same information to analyze debt and approve it, but then use the same information to decline in equity. And this is where I'll disagree with you, because analyzing debt, fixed income loans is very different from analyzing private equity. And analyzing debt, it's a fixed period, you have collateral in most cases, you're looking at credit risk, market risk to some extent, it's very different. Whereas with equity, debt is more senior in the capital structure. Equity, we're looking at a subordinated, almost inferior position in the capital structure, which means you're analyzing for the residual after everyone else has been paid, the residual profits, and it's very forward-looking. So we rely, in terms of equity analysis, on forward-looking projections, testing the assumptions that come to us from the various companies. And the analysis has to be done. We've seen cases where companies have come and some of the assumptions are very optimistic. And it's really a thorough due diligence process that has to be done. One of the other reasons as well you may decline an equity investment is our regulations. So let's talk about the pension plans and the insurance companies. They're governed by the second schedule of the Insurance Act. And in there, it's very clear that in order to invest in equities, they have to be dividend paying or the ability to pay dividend over the past 5 years, which private equity or the companies who are eligible for private equity, they will not qualify. However, the second schedule also does allow, though, for pension plans and insurance companies to invest in shares of a venture capital company that is registered under the Venture Capital Act. So it's quite interesting that the laws and the regulations will allow for pension plans to invest in shares of a venture capital company, but not private equity, right? And I mean, if we look at Jamaica, we're talking about Jamaica. Jamaica, they're actually amending their legislation now, and it should happen very early next year, for pension plans and insurance companies to invest in private equity for up to 5%, but it's still, and they're allowing it as an investment, so this is where we take the lead there. Because if we can allow shares in venture capital, we should be able to allow shares in private equity. You mentioned that, are we culturally averse to ownership? If you look at the stock market, look at all of the IPOs over the past 7 years, all the large IPOs, no, because the IPOs have all done well. We've seen investors become comfortable with equity. But what we've been seeing, though, is all of those successful IPOs and the equities that are doing well are stable, flowing dividends. So again, going back to our culture, we're looking to the equity markets for fixed income-like returns. Correct. Companies that are paying consistent, flowing dividends, which is private equity is very different. And I know Mr. Dutton, in his opening remarks, he mentioned patient investments. That is what we are missing as a culture, that patient capital. Because private equity is very much about almost the first 5 years, 5 to 7 years, depending on the strategy of the company. You are not going to get positive returns in some cases, and you certainly may not get any cash flows or returns coming back to you. But it's that patient capital that is missing in our market.
I want to go back to something that you said, which is very important and very thankful that you pointed it out to us in terms of that gap between the venture capital versus the private equity, registered versus non-registered. Having identified this gap, as they say, has anything been done? Has there been a discussion in that respect to address that?
In terms of the gap, I know that there would have been consultation when the recent revision was done with the industry. In terms of private equity specifically, I am not aware that it was raised as a specific investment to be allowed in, but the discussion would have ranged around that whole criteria for the equity, where in order to invest in shares of a company, you have to have that dividend paying period of 5 years or the ability to pay dividend, because that severely restricts the ability of funds to take that kind of exposure.
I mean, in our market, it's relatively easy to approve debt. You have a property? All right, good. 75, 80%? No problem. Give me a personal guarantee. 2. Okay. The interesting thing is that, and all the bankers here would know, especially if you started off in credit, they always tell you the first way out of any debt is through, anybody? Your cash flows. They never say your first way out is through selling a property. But interestingly, when you have to analyze equity, similarly, your analysis is based on the cash flows. Now, granted, one is backward-looking and one is forward-looking. And the past is not necessarily a predictor of the future. But ultimately, there are significant areas of overlap in analyzing a company for an equity investment, particularly private equity. I'm not really going on to the public side, although I'll come back to that, as I mentioned earlier, because I think that's one of the challenges. But at the end of the day, there is similarity of overlap between doing an equity and a debt analysis if you start from the position that you have to analyze the company's cash flows. And to analyze the cash flows, as Sana said, you have to test the assumptions. Testing the assumptions means looking at their business model, how are they structured, the management capability, who you have on the board, what is the expertise being brought to the table, their market and their marketing, what are the areas of concentration in the business and how risky are those areas of concentration, how could they be mitigated. So there are a number of things that would take you into a lot of the equity analysis that you would have to do. But this is now equity analysis from a private standpoint where you look at it a lot more like a credit as opposed to, well, this is how the market is performing, and on a technical basis, prices should still go up because you're in a macroeconomic upturn. So there's that, but for some reason, and I do think that there's a cultural shift that has to happen, and the question is who has to lead that cultural shift in how you think about private equity in general in Trinidad, because, beyond the institutionals and the big corporates who you mentioned, and maybe a couple individuals who have good stockbroker partners who inveigle them to go and invest in equities, even high net worth investors largely try to get more conservative portfolios. Very few investors, particularly on the individual side, actively seek out equity returns in the Trinidad market. They may have foreign portfolios and foreign fund managers who blend equities into their overall managed portfolio, but by and large, and again, part of it is that there's illiquidity in the market, so 20 shares traded could move a stock price by $5 down and give you a $180 million mark-to-market loss at the end of the month. No, I'm not tooting, I'm just saying. But yeah, kind of. But the fact of the matter is that from an analysis standpoint, I think that there are a lot of similarities, but there needs to be a drive to get more of that out there, and there needs to be a drive to have the asset class being looked at as a more viable option. Some of it is getting over the regulatory issues that Sana mentioned. Some of it is education and outreach and getting people more comfortable and familiar with it. And part of it is people just aggressively trying to push it more. And things like this breakfast seminar are part of getting that word out there, making people more familiar, more comfortable, understanding what exists. And these are the kind of things that could catalyze it going forward. So no easy answer to that question, but I think that there are a number of things that exist currently that can help to move it forward. And so this room and those beyond this room are the ones to help it get there.
I kind of alluded to the cultural reason in answering the first question. I think that the way how the market has evolved in Trinidad, the investment market has evolved in Trinidad is a major sort of contributor to the culture. I agree with Dwayne and to some extent disagree because I don't see a distinction in assessing the credit, whether it's fixed income or equity. I think the approach should be substantially the same. But the issue in terms of involvement in investment in private equity is takeout, really. We've had one issue on the Junior Stock Exchange, that was, and I say diplomatically, moderately successful. So, you know, you have to in making a decision on going into the market, that's not encouraging and does nothing in terms of development of a culture of risk-taking, either on the investment or on the issuer side. So I kind of harken back to my initial point. If you can invest and get reasonably decent returns at low risk, then rationally that's the decision you will take. Until that changes, I expect a continuation of the same.
Joseph, your thoughts?
Okay, yeah, and I would want to take it from the cultural perspective, and I think part of the question is, are we averse to ownership? I think there's a contradiction in the cooperative credit union movement, because as members, we are all part owners of the credit unions that we belong to. But the question is, do we see ourselves as owners in the real context of what an owner is supposed to be, as against being a passive shareholder, just allowing the board or some committees to run the business, and then you take it from there. So I think it's a yes and no situation with respect to being averse to ownership, because yes, we are owners by the fact that we are shareholders, but we don't actively, I don't think the majority of us see ourselves in that context as owners. With respect to the issue of the investment opportunities for credit unions, a lot of credit unions have engaged in the IPOs that have been on offer, and there would have been approaches to the league and through the broader umbrella bodies for credit unions to get involved, and there would have been allocations made specifically for the credit union movement, so that they would have been part of those things, and they see it as, sometimes they see it more as an investment than as an ownership issue in terms of some of those institutions that they put outside there with the IPOs. And it's something that I think we have to change the culture in terms of how we see ownership. Because most times we look at it strictly from what kind of returns on my investment I could get, because as a board member of a credit union, at the end of the day, you are driven by the fact that at an annual general meeting, there's an obligation for you to report to your membership and make a determination as to what kind of return on the investment, what dividend payment could be allocated based on what we remember is a non-profit organization. And as such, the returns go directly to the membership. And the members' expectations are that at the end of the day, I am going to get some reasonable return on my investment in the institution. And those are the kind of balancing act that the credit union has to do with respect to how far do you go in terms of your investment, how do you consider it as ownership, but at the same time satisfy the members' needs for some relatively good return on their investment. Because at the end of the day, we are in a market in Trinidad and Tobago, there are other financial institutions that are there, and we have to drive the membership culture to our members in the cooperative credit union movement so that they could take a more active role in the development and in the advancement of the movement, so that they could get the necessary returns at the end of the day. And I think the issue is a cultural shift, a fundamental cultural shift that has to take place, and it could only be done through these kind of forums and the education that we afford to our membership. So I think the issue is, how do we change the culture of ownership in a fundamental way?
Thank you very much. The next question is more along the lines of the regulatory framework and the regulatory culture. The domestic debt market is reasonably seasoned, yet still bringing new debt issues has proven to be at times protracted. Is our current regulatory framework resourced and in a position to usher in multiple private equity issues? Should they present themselves? And if so, what should be expected of issuer, arranger, and regulator to make this process expedient? So I'll ask Ethan to start on this one.
From my perspective as CEO of the exchange, I am not at this point inclined to add to my staffing on the folks who do the assessment of the proposals that come in. I hope that over time we become more responsive as an institution and more transparent, because I think the major issue was transparency. Let me just say, though, that from a technological perspective, we are engaged in an exercise that will hopefully allow us to process the run-of-the-mill applications more quickly, and therefore be able to spend more time on the more complex applications, those that require prospectuses and so So that process is gonna hit the market in early 2020. What I've found is that when proposals come in, and I wonder how the distribution of labor around a market issue is done. Because the proposals come in and you have repetition of the same sort of issues that we kind of have to deal with. And so I wonder whether the people who have the expertise in putting together proper prospectus, for instance, are actually doing that, or whether they're farming it out to the legal people who may have knowledge of legalities, but in terms of the business, there may be some shortcomings there. So because the things recur, and that shouldn't be the case. I think beyond that, we will continue to process and improve the processes as over time, and if there is a demonstrated need for additional resources, then we will make the appropriate decision.
Thank you.
So, Chris, if you just allow me this, I would like to, as we have the regulator here, just publicly let everyone know that the MPC Caribbean Energy deal that came to market last year, which is actually a private equity deal that was listed, I would like to publicly commend the regulator, because that, after all the IPOs we have seen and prospectuses we have put into the SEC, that was actually done in record-breaking time. In about 4 to 5 weeks, that prospectus was approved. And that was one of the more complex deals that has come to the market in Trinidad and Tobago in the stock market. So I think So I think the SEC has actually, they do have the resources and the team to actually, to look at private equity, because we've seen it in the recent.
Well, it's a good time to ask both parties, what do you think went well as compared to times gone by in this respect?
So,
Well, let me just, as everyone here should know, we are not merit-based, we are disclosure-based. So our focus is on ensuring that an investor has all the information that would be required for them to make an appropriate decision at all times. So it's at the inception, and as the company progresses over the years, if there are developments, you're told immediately, you're advised, and you make appropriate decisions, and that's where we start. We are not about what is a good investment, what is a bad investment, what is risky, what is, and so on and so on. Much like the U.S. Stock Exchange. Like the U.S. Stock Exchange, and I use them as just an example, I pull it out of the air. What helps is early engagement. So there the proposal is, all right, I will work with you over a 6-month period before we finalize the paperwork. All right? You come into me, we work. And we finalize the paperwork, and that works. From an outsider looking at it, would appear that the turnaround was a month, but they're actually working on it 3-4 months, because they and that has tended to be an approach that works. But that said, I mean, again, I make the point again. I mean, there are some pretty standard information requirements, and it's about being clear and transparent about all aspects of it. And there's some pretty standard disclosure requirements that over and over again, when they come in, they're sort of overlooked or they're so on. And so we wonder about, what's happening and why that's the case. So that's kind of the approach. I mean, that would have been one particular relatively complex example that we worked behind the scenes on, and that process will continue.
Just a quick question, Hayden, though. I mean, I agree the SEC's role is to make sure that there's appropriate disclosure and transparency, but at the same time, in any investment, the onus is also on the investor, particularly for private placements, to get their own independent legal, tax, accounting, investment advice as well. So I'm just trying to maybe rebalance in my mind, and maybe you could give me your take on it. With respect to, is the SEC trying to protect the investor too much by trying to do everything for them, not letting them get their own advice that they will then use to make an independent decision, assuming that all the standard disclosure and transparency provisions and information are included? I mean, to what extent can the SEC step back and let investors be investors?
I'm not too sure if you're suggesting. I mean,
I'm not suggesting that you abdicate your role. I'm
right.
just saying that we have a history of overly hand-holding.
Right.
And there is a rule, and the disclosure is in virtually every information memorandum or perspective I've seen, is that despite all of this, you still have to get your own independent advice in all the different areas before making an investment decision. And of course, that would have been subject to the SEC already providing its feedback and review. I'm just trying to get a sense from you whether you think that is something that can be considered, or whether we're not at that point yet, because I still do think that is one of the reasons why things get a little more protracted. I think maybe the SEC is trying to do a little too much for the investors rather than let them do some of the work themselves.
Okay.
Certainly this question
Some more of the work themselves. Sorry, was that a
has
question?
prompted some discussion. So next time I should put this question first. Anyway.
Yeah. Can I
Thank you very-
respond?
Yes, absolutely,
Yeah.
absolutely.
Sorry, Joseph.
No problem.
So, I mean, one of the other major initiatives is our investor education exercise and program, which is, our constant challenge is to reach the investing public where they are more effectively and so on. And despite all our efforts, we did an impact assessment. We ended up in a situation where there are about 17-18% sort of market knowledge, investor knowledge. So it's very low, despite it, very, very low.
Institutional, accredited investors, or just general?
I'm just talking across the board, and it's really to ensure wide is possible investment activity, because Trinidad, as you know, is driven by institutional investors and so on, and that's not necessarily where you want to end up on this.
The only reason I ask is because for private placements, which is usually to sophisticated investors, the time also takes quite a while, and they would have been, at the other end of the spectrum rather than a public prospectus. So I'm just trying to get your take on, particularly where there are private placements that usually go to sophisticated and institutional investors.
Okay.
If, the rule of the SEC in...
You're talking about limited offerings?
If you're doing a limited offering. I mean, for a public offering, yes, the general public would be less sophisticated, and there would be a need for increased oversight into what actually gets disclosed, but particularly for limited offerings.
We have 10 days to respond to limited offerings. So that's
in the regulations.
That's what the regulations. After 10 days, you proceed.
Okay, with respect to the regulatory aspect of it, and this is one of our major challenges in the Cooperative Credit Union movement. And just want to take an excerpt from the Cooperative Societies Act that speaks to the issue of investment of funds. And it says a society may invest or deposit its funds in any bank approved by the commissioner. So it said approved by the commissioner. B, in any securities issued or guaranteed by the government. In shares on the security of any other society, provided that no such investment shall be made in the shares of any society other than one with limited liability, or D, in any other manner permitted by the commissioner. So a lot of our trust towards investment and towards those things are very much regulated, right? And I think the challenge we are having now, and as a movement, we are now actively involved in discussions with respect to the revision of the legislative regime that's supposed to govern credit unions. And if we could recall, some years ago, there was an attempt to introduce the credit union bill, which we had to resist based on the fact that it was not consistent with what the unique nature of credit unions were. We have reached a stage at this time where we are having discussions with the Ministry of Labor, who is the line ministry for the regulation and supervision of credit unions, and also a cabinet-appointed committee that is talking to the issue of regulations for credit unions. And we believe we are making some progress along those lines. We would like to see an independent regulatory body that is cognizance of the unique nature of credit unions and the fact that they are not just financial institutions, they are strong social institutions that have a strong financial aspect to it. And as such, we would like to see the legislation crafted with that in mind. And as such, the discussion we are having now is pointing us in that direction. We are aware that we are into a very different financial environment and the fact that regulations has to change. We are not averse to any improved regulations to govern the operations of credit unions, but we can't be regulated like banks because we are not banks. We can't be regulated like the other financial institutions, and I think there are best practices in other Caribbean regions where they have independent regulatory bodies that took into consideration the unique nature of the cooperative credit union movement. So it sometimes restricts us in terms of some of the things that we can do as a cooperative credit union movement, and we are mindful of that, and we are making very strong strides towards having a regulatory regime that will allow us to move, and the issue of private equity and all those things have to be factored in terms of the discussion, in terms of how the regulations are structured. So we are mindful of the challenges that it poses to us, but we are saying that we want the improved regulations because we want to see credit unions advance and take their rightful place in terms of national development and providing that economic space for persons who are not involved in the mainstream commercial banking sector. And that is where we sit at this time.
Thank you very much for these responses, and it is very clear that the whole regulatory aspect of what we are seeking to do requires far more dialogue, and in the circumstances, we certainly want to create a forum, something like this, to continue our discussion in a more pointed way. At this point, I know we've been very tight on time, so we invite members of the audience to pose questions to the panel.
Thanks, Chris. All right, as we queue up questions, I have a question actually. So I listen to what you guys are saying, and I hear a lot of talk about culture and regulation. And what I want to know is, okay, I look around this room, I think I see, and correct me if I'm wrong, I see people who have the power to make changes to the policies, make changes to our lending policies, investment policies, asset allocation. So my question is, what's stopping us from doing that?
Sana?
I'm sure start with the banks first. So in terms of, so Kevin, to answer your question, it has been happening. So if we look at the banks in particular, it has started to happen in certain corners of the industry. Some of them are in this room already, where they are actually looking at how capital can be allocated for more risky type investments such as private equity. Banks, as you all are fully aware, the business model of banks is around, the core business model is lending, right? It's about fixed income, loans, and debt essentially, and analyzing credit risk. But there is a trend, and we've seen it globally, if you look at the big four globally, where they are carving out that capital, and whether you put it off in a subsidiary, a separate vehicle, but it is happening where they are putting that capital aside to say, look, this is what we will put aside for private equity. So that trend is happening. It has already started in some corners very quietly, maybe not publicly yet, but very quietly among the financial industry. And, you know, you would see that evolve in the future.
Any thoughts, gentlemen?
Well, I think the issue of, and the question is why it is not happening, you know, and at least from our perspective, we are actively engaged in discussion in terms of amending the regulations and the legislation. And I think we are the more aggressive ones in terms of trying to have some amended regulatory regime for the credit union movement. What we have been saying very strongly is that we don't want regulations that are not in the best interest of the movement, because I don't think the bankers, and with all due respect, they would want to have any regulation that is not in their best interest. So it's the same thing we are saying also. We would want to ensure that the structure of the legislation is such that it continues to aid and continues to look for the development of the cooperative credit union movement, because we feel that there is a space for us. We have crafted that space. We have over 500,000 members actively involved in the activities, and as such, we would want to be heavily involved in that. I think the challenge we have is the political will in the broader sense, because remember, at the end of the day, parliamentarians are the ones who eventually pass these things through some kind of bill in Parliament, and it all depends on the kind of lobbying that you do from a ground level to ensure that you get your interests represented where it is rightfully supposed to be represented. I think that's where the challenge is in most of these circumstances.
I have a simple and maybe slightly more cynical comment, which is that the people who have to approve the policies are the ones thinking about this is a debt-based society. Right? And them really want to pass nothing too much, no equity thing that they ensure they could sell
That's right.
in the event that something happens. So I think that, yeah, it's changing. I mean, as Anna mentioned, it's changing internationally. But because of some of the structural peculiarities of our market, I think that for it to really happen, it'll have to be driven by this body. I mean, Kevin said that, you know, people here could make it happen. Maybe one or two, but most of the people here are not passing policy. Most of the ones here are trying to execute on the policy that is passed and make money in a way that until the policy gets changed, they could do something different. So we have certain amounts of influence and leverage from an executive standpoint, but ultimately you have to get buy-in across the organization, particularly at the board level, where the policies are going to get passed for it to actually happen. So this is why something like this is important, because it starts getting the word out there that this is happening, it's happening internationally, it needs to happen here. We have some market idiosyncrasies that we have to sort out, but at least if the ball starts to roll from here and it moves on from here, slowly change will happen, but it will take a while.
Eden, any thoughts?
Well, the Commission is constantly engaged in legislative updating and to some extent additions. I mean, there's some, so there's a focus on market development, which is one of our mandates. There are also some areas of the market that have kind of structural weaknesses that we're focusing on now. The collective investment scheme sector being one, the repo market being another. We're also looking at our takeover bylaws legislation and so on. So that process is continuing and ongoing, continuous. We have a department that does that. That's all they do.
Thank you very much. Members of the, Maria Daniel.
Maria Daniel, EY. I heard you all talk a lot about the regulations and what we're not doing right, why it's not happening. I mean, I've been trying with private equity for a very long time and trying to get people in this movement. But there's another thing called trust and transparency, and it's from the investor side. So Sana spoke about, you know, yields and the Jamaicans going after yields. If we look at everything where there were high yields, it has collapsed. Clico, double figures, collapse. Hindu Credit Union, looking at investments outside of the core of the credit union, collapse. So yes, from the regulatory side, we could say, okay, sometimes the SEC is not as respondent, but after the prospectus, then what? How are investors aware of what is going on? When we do a due diligence on a US company, we don't even need to go in the company to find out what's happening, because there's constant disclosure. You know every quarter what is expected. You know where they're taking their company. When I invest in equity, I want to know where are you taking the company every quarter. And from the private equity company side, what I'm not hearing is where is that going to come from? So I invest personally into small companies. And the problem isn't always the capital. It is what happens to the company afterwards. They need help with marketing. They need help with getting the businesses going. So if we have to have a private equity fund, and I think the solution is actually where Sana was going, which is the banks have to come together. See Richard Sammy here, we have GMMB here, put a few $1 million each, because if you have to write off 20 million, it's not going to collapse Republic Bank, right? So what we need is some success stories, which we haven't had. At the Jamaica Stock Exchange, we talk about what is different. Every company that goes on the Jamaica Junior Stock Exchange has to have an independent director that has been approved. So there's somebody outside of that company looking at what is going on in the company for the investor. So it's more than just why it's not happening. There's a whole culture as well. Let's be honest, Jamaicans support Jamaicans. So that's another big cultural thing. In Trinidad, we don't have that. So we need success stories because at the end of the day, until we have a real company that got private equity, exited on the stock exchange, and everybody is happy, the bandwagoners of Trinidad and Tobago will not follow. So I don't know what are your thoughts there in terms of, yes, we could have these forums, and I'm glad KCL is taking the direction, but you need enough capital for this to make sense. There are deals out there. There are many entrepreneurs that need patient money. DFL in the old days, I don't know how many people know this, but Associated Brands first started with DFL. So we need patient money with success stories that the market hear about to get the investor confidence. So I don't know what you all are thinking of in terms of, again, this private equity. How are we really going to get that investor confidence out there?
Well, do you know, I think Maria's pointed the question for starters to you.
I
So
thought she said in the
you
old
have-
days.
you're the new DFL. So please,
Well, I agree fully with Maria. It's very interesting. A month ago, we went St. Lucia talking about this very same thing with the St. Lucia Development Bank and the Development Bank Conference. But it was more the role of development bank in banks in trying to help private equity, specifically on that panel. But the reality is that the large pools of capital exist with the large commercial banks. And unless there's the impetus to actually set up something that is capitalized independently, managed independently, but with specific targets, I think it will be difficult for private equity to really flourish. And then, as Maria said, get the bandwagoners on board. From a non-commercial bank standpoint, I think that, as I said, there's a clear gap in the market for private equity. And I think it has to happen, and it will happen. I'm not sure how quickly the commercial banks will get on board with setting up a separate entity. You might quicker find some of these securities companies, broker-dealers, maybe getting into it more independently, or maybe there's the opportunity that it starts there. I mean, at the STAT level, I mean, that is something that would probably appeal a lot more because it's more aligned with the broker-dealer businesses than necessarily the commercial banks. And then a lot of the broker-dealers are aligned with commercial banks. So maybe they need to advocate for this as a specific area of focus going forward for it to get some of that capital allocation to try and make it happen. And I think it will really be up to that sector to lead those big banks and those big pools of capital for it to actually take place. Without that kind of advocacy-led initiative by the broker-dealer arms of the big banks, I don't know if independently at the commercial bank strategic levels, they are actively searching to get into private equity. So I think that is the avenue I see the big banks getting involved. I do see at the STAT level and at the NFI level that there may be more impetus for those entities to themselves get more involved and look maybe to do something jointly. One of the biggest problems we have in the banking sector is that everybody is so afraid of sharing any client information with another entity, even though that person probably banks with all the bloody banks, right? So we need to try and get over that. That's one of the things actually holding back our financial sector. I'm not saying that you're going to release confidential information, but at the same time, banks need to learn how to share stuff, and they will make more, not less. And so it can happen with something like this, and it can happen with NFIs with something like this. And that is the way that you're going to get this initiative moving forward. Get that going and solve the exit strategy in terms of people being able to cash out. And I think that we'll have a real case for the private equity business to go forward. I mean, right now, I'm looking for private equity for my businesses. Wink, wink. And, it's difficult at the angel investor seed level. And that's me. I've been in the business for 20 plus years. So I'm just saying that it's going to happen, it has to happen, and I think there's a way for it to happen, but as Kevin mentioned, what is going to do it, who's going to move it forward? My suggestions is what I just said.
If I could just to remind you on one thing, you mentioned the broker-dealers, but just to remind you that many of the banks that we're referring to here are actually groups that actually do have those subsidiaries and arms and broker-dealers already. So it may not be as slow as you think for the banks to actually to get together, as Maria has been suggesting, and create that vehicle. But to comment on Maria's point and to add to what she's saying in terms of the credibility and the trust issue, it's what is needed in Trinidad, and hopefully with Aspire and MPC, if it can take off successfully, and we do see that happening, and I know Kurt Kisto and his team has other funds, is we need more and more of these funds to really gain credibility and a track record, so that the bandwagonists, as Maria says, can actually jump on at that point. So I think with these initiatives, it's really taking that leap and developing that track record so that people can see that private equity can be good for your portfolios, and it's a good diversification and can provide high returns.
Okay. Joseph?
And it was interesting that she mentioned the term Hindu Credit Union, which we are still feeling the effects of what happened there as a movement, because in most of our discussion, there's always reference to what happened with Hindu Credit Union. But just to clear it up, that we, very early in the game, we had said that they were not operating consistent with what was required for a cooperative credit union. And I think that had more politics to do than anything else in terms of regulation. I'm being very brave and bold here, but that is what we saw in the movement. We were saying it all along, that if the regulator would have been allowed to do what the regulator wanted to do, we would not have found ourselves in that situation at Hindu Credit Union. But the regulator, because our regulator, and that's something that is strange to us, our regulator reports to a public servant in the Ministry of Labor. And the Act says it's supposed to be some level of independence for the regulator. But how do you have independence when you are fettered by the regulations of the public service? And I think that's one of the things we are trying to move away from. And that's why we say we want an independent regulator, because the regulator had to take instructions from a public servant who was given an instruction from a politician, and that is why the whole Hindu Credit Union thing collapsed, and it has placed a trust issue in the movement. We have not had any situations like that in the movement at all, because all credit unions are fully aware of their obligation to their membership and to the fact that there is a moral issue in the credit union movement, and the values that we subscribe to are values that talks about the issue of transparency and protecting members' funds, and that's something that I would hope that we will continue to see evolving as we go along. And I just wanted to say something with the Jamaican reference. You see, Jamaicans love Jamaicans. And I wanted to use that term here. They are patriotic. But you know, if you say that now in Trinidad and Tobago, it will create a lot of issues, right? But I deliberately said that because the Jamaicans will support anything Jamaican down to the hilt. Are we the same in Trinidad and Tobago? I'm not sure. I'm not sure.
Any final comments on that?
No, I'll just reiterate, a big step would be to resolve the takeout issue, the offtake, and that's the extent of my contribution.
Okay, thanks. I understand we have time for 2 more questions.
Okay. Does the current conversation going on about patriotic $700 million investment for the refinery speak to our cultural views on private equity?
No, that question is directed to. Well, let me say up front, I can't answer in total detail on some of the issues with patriotic because I'm involved as a member of the evaluation committee, and NDA suggests, and non-disclosure argument suggests there are certain things you can't talk about. But I just use the reference in terms of some of the comments I'm hearing in Trinidad and Tobago in terms of local ownership and local involvement in some of the highest forms of industry business in Trinidad and Tobago. But I am, from where I sit, I would really like to see Trinidad and Tobago, some of the private sector in industries and those things, get involved in some of those critical aspects of the country's economy. And we could do it just as the Jamaicans have been able to do it. I think in Trinidad and Tobago we could do it. I've been saying the same thing in the cooperative credit union movement. We try to use the Jakul business model as a guide, but we don't follow it. We always talk about it, but walking the talk is what is of critical importance to us in a country like Trinidad and Tobago. So that is much I could say on the issue of the patriotic thing until that time comes when there'll be full disclosure in the public domain.
Okay. Any other questions?
Good morning to all. I just want to put a different spin on the conversation. Now, we speak about risk and our aversion to risk and all of these things. There's no investment without risk. No single investment without risk. And I've listened to the banker who would have indicated that in terms of private equity, that Aspire and KCL and other companies should consider going that route, but not the banks. I want to disrupt this thinking as how we speak about risk. We are not a culture that would consider risk and would now accept risk. So what we do, we look at the traditional investment model and we go down that road. So the banks will ensure that you have your assets and everything like that to cover your loan and your investment. If you look at the spread, and we are speaking about yield, yes, the yields have declined. However, the profits of the banks are going in the opposite direction. So what are we to do as the average investor? You must provide the framework for that investment. And the framework will suggest to us that we should have confidence at the regulatory level. And I want to go back to, if you look at those companies that are on the stock market, the TNT stock market, you have a lot of interlocking directorship. So you have sharing of information at that level. But when there is an issue and the public did not see resolution of that issue, where are we to reside and to repose our confidence? You had an issue with the FCB IPO, it's yet to be resolved. You had an issue where you had this conversation with regard to Guardian Holdings and the whole issue with the NCB arrangement, where a few shareholders decided to get into an arrangement to have their shares sold at a different value, at a different rate to the other average investors. These things ought to be resolved. You had issue with regard to Guardian Holding and the whole issue of insider trading is yet to be resolved. And the representative from the SEC is here. And if these things are not resolved and resolved in a timely manner, where would the average investor be able to have this level of confidence in the institutions? That is what will breed the level of confidence for the average investor. If you see transparency, accountability at the level of the executive leadership and the board of directors, you will have more confidence. Because most of the times, loans are granted, and large loans are to institutions that are part of the corporate circle. So private equity, that will take the back burner until Aspire and KCL launch out there, and you take the risk. When we see the example that these institutions who KCL and Aspire would have supported, and we observe the success story, then the banks will now get in and say, we are going to provide some part of our portfolio to take that level of risk. So we have created the culture of risk aversion, and it is perpetuated at the level of the banks. And until and unless we provide the support at that level, and I heard the person from EY mention it, why don't you not allocate a particular percentage of your portfolio for private equity? No. Aspire, KCL, you do it. And then if it is that we have a success story, we are going to follow. So my question is, the responsiveness at the level of the regulator, particularly with the equity market, and why don't we have resolution of those issues in a more timely fashion?
What I will say is, in response to your last comment first, the approach of the Aspire funds is exactly that, where a portion of financial capital is made available. But where we are today is developing that framework, the governance framework, the due diligence framework, the financial assessment framework, and to gain a collective view and somewhat of a working paper get going in the industry so people can say, yes, this is what we like, to get the framework inside of there. Whatever you look for as a financial institution, individual investor, as a framework, we want to get alignment industry-wide to get people comfortable with, okay, we are looking for the same things when we are seeking returns and investments in private equity. And without going too much into that, what I'm saying is that, yes, you are correct, and this is in fact the approach that is going to be the approach, certainly at the Aspire level, and we will get into that more in the second session. And of course, you have raised issues associated with the regulatory framework. Without putting Hayden on the spot, if he'll be kind enough to give some sort of response to those historic issues.
Yeah, well, clearly there, your point is valid. I mean, we need to respond very quickly to these issues as they crop up in the market, especially if they point to contraventions. We have, in fact, substantially resolved the Guardian issue, as you should know. I mean, there's still one other matter that we're working on. As you can imagine, those matters tend to be very, very complex, because if someone is planning a particular activity in the market that, invariably that person has the benefit of extensive and high quality legal and financial advice. So unraveling the thing normally takes a long time, not only in Trinidad, but in several jurisdictions. I harken back to the US stock exchange. They speak of matters that take 5-6 years to unravel. It's not, these things are not done on impulse. They're done if indeed they are, and I'm not saying that they necessarily are. But there's a lot of time spent in putting them together, and there's a lot of very, very expensive advice that goes into it. But I expect that we will have resolved both matters certainly by the middle to the end of next year. Okay. But I take the point that we need to respond as quickly as we can when these things occur.
Thank you. We have time for one more question.
Yes, for a final question, Mr. Romano.
Thank you. Good morning.
Morning.
One question, one suggestion. I'll go with the suggestion first. No bank is going to put money into private equity in the traditional banking structure. If they're going to do it, they will need to ring fence and put a separate entity charged with investing and possibly losing money. And whoever is going to run that has to be comfortable and confident enough that their back is going to be protected when they make the bets. The question is, and it goes back to what Maria said, the question I have is, are the entrepreneurs prepared to do the hard work? Because too many times, and as a banker I can tell you, too many times people are walking into the bank for loans, but it's the same way they will go to a possible investor, and they lack credibility. They don't have proper accounting advice, they don't have proper legal advice, strategic, marketing, you name it. Are our investors, are our entrepreneurs who are looking for money, whether it's from credit unions, high net worth individuals, are they prepared to do the hard work, and are they being properly advised?
Do you want to take it? Do you know it?
Well, it's a very good question, Nigel, because sometimes you don't know what you don't know. So, for instance, over the last month and a half, myself and one of the directors would have been in Tobago talking with the THA about trying to put on some type of a workshop or seminar for entrepreneurs in Tobago to help them build capacity to do exactly what you are talking about, which is put them in a position where they become ready to access capital, whether it be debt or equity, but primarily debt was being spoken about at that particular meeting. And part of that delivery would be to bring accountants, lawyers, people with skills that can provide some type of advice separately afterwards, in addition to bringing some capability to help with strategic planning, business analysis, things that entrepreneurs typically tend not to maybe have fully fleshed out because all they're doing is studying just how do I get this business up and running and making money. So I think that, the question is spot on. And of course, the fact that, getting a business up and running is hard. It's hard work. And again, maybe it's cultural, maybe not, but, I use it to the point I stated about the private sector and the real private sector. Not that it's easy to align yourself to get government contracts, because that takes a certain skill set as well. But to be a market-driven private sector entity is hard work. And, it means that you need to think about the business strategically. You need to look at all the aspects of your business, whether it be from supply chain, whether it be your marketing, your resourcing, what type of senior advice and oversight you can get. It is hard work. And who is advising those people? That's where I think the big challenge is. So maybe E&Y, who has, and some of those advising firms and consulting firms have capability to do that, but I can't say what Maria and they would charge. But I know that E&Y is an international company, so you might have international prices. I'm just kidding, Maria. But apart from that, that is something that, there's a need. There have been many government agencies that have tried to do things like that, provide some type of advice from a venture capital standpoint to entrepreneurs or, for small businesses getting up and running. But I think that it's not really going to happen at the government level. It has to be done at the private sector level. The question is, where does it reside? I don't think it's economically viable for banks to set that up, although, as Sana mentioned, maybe in their equity or advisory or brokerage subsidiaries, maybe there's room for that, but then again, to what level can you go down? And so for those true entrepreneurs who are really now getting up and running, you're gonna have to rely more on some of your personal network, your connections, and as well seek out people who might have done it before and independently try to reach out and get some of that capability. But you have to be self-aware enough to know what you don't know in order to access it. My take.
Sana, any comments? Final comments on that?
So I think, I agree with what Dwayne is saying. It's really education, and not just from education is needed for both the investor and the issuer perspective for private equity to really take off. So it's, forums such as these, and hopefully there are many more to come in terms of training from the investor perspective, what you should be looking at from a private equity perspective, how do you do private equity analysis, and then the issuer side, how should they come to market, what do they need to come to market, what should they be willing to give, the information they need to have ready, et cetera, et cetera. So training is important, education is very important.
Thank you. Joseph, any final words?
And just wanted to piggyback on what she said, which is the issue of training and development. And it really resonates with one of our cooperative principles, which is education and training, which is a critical principle. And the league, at the beginning of the year, we developed a calendar of events. Embedded in that calendar of events are multiple training programs. And we have a leadership seminar, and we were happy to have KCL be part of that seminar with us, that leadership conference, where they spoke to the issue of investment, to the leadership of the credit union movement. So I think the issue of exposing the leadership to those kind of opportunities and those developmental initiatives is critically important. And Nigel raised an important question, is that when persons come to you, are they prepared? It's similar with credit unions. if we have to go outside there, are the board members or your committee members fully aware and prepared to go outside there and engage in those discussions? Is the credit union, has the credit union done its proper due diligence internally to ensure that it has all the necessary resources and information available? So when it goes outside there on the market, it is well prepared to deal with any situation that arises. So I think the issue of training and development and education is of paramount importance as we go forward.
Well, ladies and gentlemen, the end of the session here is actually the perfect start and perfect segue into the second session, how to make it happen. So on behalf of Aspire, I'd like to thank each and every one of the panelists and, of course, an engaging audience. Thank you very much.